I think that this is a pro-business, deregulation, low regulation, pro-business, low tax, pro-innovation administration, in general, and everything they're doing. All of those things will be good for Bitcoin over time. You're talking to a maximalist here. I'm beyond the investor. It's not my skin is in the game. I'm beyond that. My soul is in the game. Look, Bitcoin's going to grind up 30 to 60% a year for the next 20 years.
In this episode, Saylor unpacks why Bitcoin isn't just an asset. It's a monetary revolution. While traders chase headlines and flip coins over interest rate moves, Saylor sees the big picture. A world drowning in debt, central banks cornered, and Bitcoin emerging as the last exit from fiat collapse. Forget chasing gains. This is about owning digital property before Wall Street, governments, and banks lock everyone else out. Rates down? Bullish. Rates up? Even better. Because at the core of every scenario, one truth remains. They will print the money. Saylor explains why he'll keep buying Bitcoin at $100,000, at $1 million, even at $10 million. Because in his words, Bitcoin is Manhattan in 1720, and most people still don't see it. If you care about wealth, freedom, and where this is all heading, this is a must-watch. Let's dive in, and don't forget to subscribe.
Best in the current administration. Trump just earlier today made a comment that he said the Fed should cut rates to ease the economy's transition to tariffs. The president is pushing for rates to be lower. On the one hand, tariffs do not go well with equities and risk assets. On the other hand, if the Fed listens to the president, either directly or indirectly, we could get more liquidity. How do these competing forces impact Bitcoin?
Bitcoin is every macro trader's favorite asset because they can trade it 24/7, 365. They can trade it anywhere in the world. They can trade it with any amount of leverage, and they can cross-collateralize it with any other asset. And they can talk about it with legal impunity because it's a commodity. It's not a security. And so that makes it the most attractive of all assets to trade on a trend. If you think there's a missile attack coming, you want to sell it. If you think the missile attack was overblown and there's not going to be a war, you want to buy it. I think when people are panicking, they tend to want to do a leverage short on Bitcoin. When interest rates and when the perception is we're going to a risk-on environment or a looser money environment, they'll turn the other way. So I do think that interest rates coming in or the expectation of interest rates coming in is very bullish for the asset. And there'll be certain points where you'll probably see it rip up because of that. I think that this is a pro-business, deregulation, low regulation, pro-business, low tax, pro-innovation administration, in general, and everything they're doing. All of those things will be good for Bitcoin over time. I think deregulation is very good, and I think low interest rates are very good.
Just a quick follow-up to that. There was a counter-argument I've heard from other crypto investors that a pro-business administration is actually bearish for Bitcoin short-term because the central bank does not need to ease as much. Perhaps the recession could be stalled by pro-business policies, and liquidity flows would not have a positive impact on Bitcoin because of that. How do you respond to that?
I think there's a lot of double reverse logic that takes place in the macro trading environment.
Yeah.
Like, for example, if you knew there was lots of inflation over the long term, the number one thing to hold is Bitcoin.
Yeah.
But when people print a big inflation number, Bitcoin will trade down in the short term. But the double reverse logic is inflation is high, therefore the interest rates are going up, therefore money is getting slurped out, therefore I should find something to sell, so I'll sell Bitcoin. And that's why I would say there are basically two ways to think about Bitcoin. Actually, there's three views. There's the trader, there's the investor, and there's the maximalist. Okay, the trader says it's an asset, I can get a handle on it, I can 50x lever it long and short. They're obsessing over whether or not good news is coming, because good news is bad news and bad news is good news, right? And then they want to make sure they're the first one to get the bad news so they can treat it as good news so they can get out of the trade before the bad news manifests, or something like that.
Yeah.
And if you're one of those traders, you know who you are, and more power to you. I'm not that guy. Then the investor view is, this is the dominant digital monetary network in the world. It's going to go up by a factor of 10 to 100. And I'm just going to hold it like Apple, like Facebook, like Google, like Microsoft. I'm going to hold it like my big tech monopoly for the next decade. And it's going to jerk around a bit, and I'm going to buy it on dips. The maximalist view is, this is property rights for 8 billion people. This is the greatest opportunity of the 21st century. This is economic empowerment for every business, every country, every family, every individual, right? I'm going to support it at all times, every way I can, forever, okay? And so you're talking to a maximalist here. I'm beyond the investor. It's not my skin is in the game. I'm beyond that. My soul is in the game. But I think that Thomas Lee, he's done some good work, and he says that Bitcoin generates all of its gains in like 10 days a year.
Fundstrat Thomas Lee.
Fundstrat Thomas Lee. And that just means that, somewhere like 98, 97% of the time, nothing is happening and you're waiting for something to happen. And I would say every macro theory about if the bad thing happens, that's good, and if the good thing happens, that's bad, and if enough bad things happen, that's really good, because then a bad thing will happen, which will be good for us in the midterm. I get it, it's all true, but I just don't choose to play the game. My view of this is, that's a game for professionals, and it's Howard Marks, he says the problem with all these day traders is the stock goes from 10 to 11, and the guy bought it at 10 and sold at 11, and then it goes from 22 to 23, and he bought it at 22 and sold it at 23, and then it goes from 33 to 32, and he shorted it at 33, and he brags that he made $3.
Yeah.
But the problem with the whole thing is, if he just bought it at 10, he would have made like 10x that much money with no stress, no anxiety, and no risk. And so I tend to think, look, Bitcoin's going to grind up 30 to 60% a year for the next 20 years. And my long-term risk cost of capital is like 29% for 20 years. That being the case, rather than try to time the market, it seems to me like a better idea would be go mortgage your house for 30 years at 3% interest or 6% interest, and then make an investment for 30 years where you have 6% cost of capital and get 30% return on the capital, and you're getting 24% boost. So I think it's much better to figure out how you raise capital and lever the trade, or how you build a business that actually cashes in on that volatility, instead of being the day trader trying to guess the volatility, because it just seems like, it's a fool's errand for the average person.
I understand.
In one of your interviews, you said when you learned about Bitcoin, you couldn't sleep because you were just afraid somebody else would learn it and they would buy it. You couldn't buy it anymore. But now you are the main force, I would argue, that the reason why everybody's buying Bitcoin, because you are preaching for Bitcoin and everybody believes you. Does that not make it harder for you to accumulate more Bitcoin?
Well, I think the equity and the beauty of the network is it gets exponentially harder to acquire Bitcoin over time, and that's what makes the network secure and stable, and that's a good thing for all of us. Bitcoin has matured over 4 years. and that's a good thing. We used to have, extremely highly levered, poorly capitalized companies driving the market, like the offshore exchange, like FTX and Three Arrows and Terra Luna and the like. And the market has matured such that now you have large pools of more permanent capital, like BlackRock's capital, IBID, or Fidelity, or Wall Street. And that will create less volatility, lower drawdowns, but it will drive the price up. And on the other hand, it's kind of like saying, your family came to Manhattan in 1700 and you bought up a bunch of land, and then you went back to Europe and you told everybody that Manhattan's going to be the greatest seaport in North America. And here we are in 1800, Michael, and your family owns like 47 blocks of Manhattan, but the prices of Manhattan real estate have gone up by a factor of 20. Isn't it getting it harder for you to do business in Manhattan? And the answer is, well, the price is going up, but there's a lot of other people that are in Manhattan that do things that we can't do. And I'd much rather have other businesses and other pools of capital, like on the day that Apple and Microsoft and Google enter the Bitcoin ecosystem, the price will go up, but the risk will go down. And one of the interesting things about volatility is, like, if you look at the risk in the space, if you have something which is 10x over collateralized by Bitcoin and the volatility is 60, well, there's a risk. And one way to drive down the risk is to increase the collateral, but the other way to drive down the risk is decrease the volatility. So it turns out you're better off being like 3 times over collateralized with an asset with a 30 vol than 10 times over collateralized with an asset that's a 70 vol. And so I think that's what's happening now. The industry is growing up. It's becoming more secure. It will be accepted by banks. It will. I'll leave it at this thought, which is, when your bank tells you they'll buy Bitcoin for you and they'll make it really easy, and you can do it on the phone, it'll cost you $1 million Bitcoin. And when your bank calls you on the phone and says, you really ought to buy Bitcoin, it's a digital monetary alternative, and when they recommend it, it'll cost you $10 million of Bitcoin. And right now, no bank's going to recommend it, and they're not going to help you buy it, and you're going to have to jump through hoops, and you're going to feel really nervous about it, but you'll get to buy it around 100,000 or a little bit less than 100,000 of Bitcoin. And I think they're all three the same risk-reward proposition, and I bought it at 10,000. I'm buying it in billions of dollars of quantity at 100,000. I'll be buying it at $1 million. I'll be buying it at 10 million. And if you're back here interviewing me when it's 10 million a coin, and you're going to say, Michael, it all worked out, but Bitcoin's 1,000 times more expensive, and don't you feel bad that you convinced all these people to buy Bitcoin at 10 million a coin? I'm going to say, well, Bonnie, the entire ecosystem is much less risky now, and it's still the best investment option. I think it's still better than buying the S&P index. It's still better than buying a warehouse in Siberia. I'm going to keep buying it. It's just like buying Manhattan real estate in the year 2025 when your family started buying Manhattan real estate in the year 1700.